Good evening, students. Have you revised the charitable trust? Yes or no? What we have done, we'll quickly revise what we have done in the last class and then only we will proceed forward. Okay, so let me just quickly revise what we have done so far. Let me just zoom out a little bit. And then we will proceed to solve a question on this. Okay, so we have done that there are two regimes, 1023C and section 11 to section 13. For the 1023C, there are specific exemptions which are there for the specific trust, unconditional exemption which are there, like the Prime Minister Relief Fund, all of those trusts which are there, right? Then educational or medical trusts which are there, which are substantially financed by the government, right? And when can we say that it's substantially financed by the government? When the government grant is greater than 50% of the total receipts. Then we have the universities or educational institution which are operating solely for educational purpose. What is solely for educational purpose? We have seen that we do not need to look into the predominant test. What we need to look into whether it is wholly engaged in providing the education. Any other activity of business which is being carried out should be incidental or related to the objects of the particular trust. If the income is from the activities which is other than the objective of the trust, or if it engages in profit oriented activity, exemption will not be available. And in that particular case, the receipts should be less than rupees 5 crore. Now, receipts, when we say, we have to take the combined receipts of the university as well as the hospital. Okay. Then we had seen the general institutions which are there, or for that matter, any educational institution operating solely for educational purpose or hospital. In that case, you need the approval from PCIT or CIT. Under section 11 to section 13, we have charitable or religious trust. What is charitable? It is defined under 213. But what is important under 213 is the general clause which is there, which is advancement of any other object of the general public utility. Now, advancement of the object, any other object of general public utility means what? That it does not involve carrying on in activity in the nature of trade, commerce, or business. What do we understand by trade, commerce, or business? That there should not be any activity which is undertaken, or the activity which is to be undertaken, it should be, even if it is business, it should be in the carrying out of the objective of advancement of general public utility. And the receipts from that activity should not exceed 20% of total receipt. We have seen the Ahmedabad urban development decision as to when can we say whether the activity is in the nature of trade, commerce, or business, where there is a substantial markup which is charged on the cost rather than the nominal markup. And we have also seen the New Noble Education Society, which I already discussed. Then we went as per the approach of statement of total income, where I said that the gross receipts you will consider, which is income derived from the property held under the trust. So you will consider the gross receipts here. You will not reduce the expenditure. Second is voluntary contributions not forming part of the corpus of the trust. So with regard to the corpus donations, as I said, it is not considered as income provided it is invested in the mode specified under section 11.5. And as far as the donations which are received for repair and renovation by the religious trust, it should be used for the specified purpose. It should be, if it is not used for the specified purpose, it should be invested in the mode specified in the 11.5, and it should not be donated to any other trust. So then that is also considered as the corpus donation. Income from government grants or subsidies, capital gains, what you will consider here, the sale consideration minus expenses on transfer minus the index cost of acquisition. Any reinvestment you will not consider over here, that will be considered as application of income. That's what we are going to look into today. Next is anonymous donation. So anonymous donation to the extent of 5% of the total donation or rupees 1 lakh. Total donation means what? The voluntary contributions which are received, the corpus which is received, and the anonymous donation which is received. So that will be considered over here. That will give you your total receipts. Then you will reduce the ad hoc exemption of 15%, and then we will consider the application of income. Now, again, in the application of income, what is considered as admissible, what is inadmissible? The operational expenses which are actually paid, irrespective of the method of accounting. So it should not be incurred. So let's say, for example, let me just give you a small note over here. In case you are following the method of accounting as cash, then in that particular case, as far as the receipts are concerned, here you will account the receipts as and when received. Right? So here there is no question of deemed application. Right? We had learned that under 11(1)(b), there is a deemed application when you are actually receiving the income either on the last day of the year, or you are not receiving, not able to apply the particular income which is not received during the year, right? So then you apply it in the year in which it is received. So that is in the case of the accrual system. So if you are following the accrual system, you have the receipts. Then in that particular case, there will be the case of non-receipt or receipt on the last day of the previous year. In this case, deemed application if applied in the next year. In this particular case, again, you consider it as deemed application if applied in next AY or the following AY. Fine. In case you are not able to apply it, then it will be considered as deemed income of the year in which it is received. And in the first case, in the first scenario, it will be considered deemed income of the year in the following AY, in the next AY which is there, in which you're not applying still. As far as the payments are concerned, whether it is accrual or whether it is cash basis, here you have to consider one thing, which is, or sorry, not the receipts. Here I should write the word income rather than receipts and payment. The income and the expense. Income, expense. So as far as the expense is concerned, what you would do is account or deduct application allowed only on payment. Application allowed only on payment basis. Here also, application allowed only on payment basis. In the cash system, we can understand, but even in the case of the accrual system, you will have to allow it on the payment basis. Are we getting that particular thing? So just remember this particular thing when you are solving the questions, okay? Next one is under the application, what we have seen is the capital asset acquired. That is allowed to you as the application, but the depreciation on that capital asset is not allowed. Also, as far as the operational expenses are concerned, in case the expenditure is over rupees 10,000, that is not allowed as deduction. In case the expenditure incurred, which is there, if you have failed to deduct the TDS on that or failed to pay TDS, then 30% of the expenditure will not be considered as application. It will be considered as application in the year in which the TDS is paid. Then building, which is, let's say, purchase capital asset, which is, or any other expenditure which is incurred from the bank loan or any other loan. So loan is applied towards the expenditure incurred. Will you get that particular part as the application of income? The answer is no. Application of income will be considered only when you are repaying the loan or borrowing. When you are incurring the expenditure out of the loan, that will not be considered as application. Only when out of the current year income you repay the loan, that will be considered as application. Amount reinvested in the mode specified in the section 11.5, that is considered as application. But if you withdraw that amount from the modes and use it for the purpose of the expenditure, that means if you are applying from the corpus donation for any particular expenditure, that will not be considered as application of income. Donation to another trust, irrespective of objective of that trust, let's say I'm into hospital, the other trust is into educational, that will still be considered as the application of income, but it should not be towards the corpus. It should not be towards the corpus. But if you are donating from the accumulated income, then that will not be considered as the application. Excess application of the previous year, again, it is not allowed. So if you are applying the previous year's excess application, if you have spent extra over the income, that will not be allowed in the current year. What is the deemed application? So in case of the income, you are allowed to accumulate the income for a period of 5 years or less than that. But for that, you should be submitting to the AO in Form 10 along with the return of income before the due date under 139(1). And in case you are accumulating, you should be accumulating in the mode specified under section 11.5. Now, in case you are accumulating for a specified purpose, and if you are not using it for that particular purpose, or you withdraw that amount from those particular funds and it remains like that, so then in that particular case, it ceases to remain if it invested or it is not being applied for the specific purpose, then it is considered as the income of the previous year in which it is applied. Let's say, for example, in previous year, 1920, I accumulated the funds, let's say rupees 1 lakh or let's say 3 lakh. I accumulated it for 3 years. So 1920, 2021, 21, 22. Okay. Or let's make it 2021. So we fall in the current year. Right. So at the end of the previous year, 2022, 23, let's say, for example, you have utilized rupees, let's say 2 lakh. So then 1 lakh will be income of previous year 22, 23. So income of the previous year in which it is applied. Okay. Then if it ceases to remain invested or ceases to be accumulated, so in that particular case, it will be the income of the previous year in which it ceases to remain invested or ceases to be accumulated. Then in case, let's say, for example, if at the end of the 5th year or at the end of the whatever year you have accumulated for, it is not utilized for which it is accumulated. It is not utilized for which it is accumulated. Then in that particular case, it will be the income of the 5-year period or the period for which it is accumulated. Let's say, for example, in case, let's say this is the case, right? So previous year 22, 23, it will be considered as my income. This additional rupees 1 lakh which will be there. So 1 lakh is considered as income of previous year. But let's say, for example, at the end of the previous year, or let's say in previous year 21, 22, let's say, for example, 50,000 I applied for relief to poor, whereas I had set aside for, let's say, hospital building. So then in that particular case, this 50,000 will be taxed in previous year 21, 22, because it is applied for other than charitable or religious or in accordance with the objective for which it is being set aside. Okay, so if it is for otherwise than objective, if I am saying that, okay, I will apply for any charitable purpose, that's fine. But if I'm saying I'll specifically apply for hospital building and I do not apply for that, then that will be considered as income. Then we had seen that deemed application as per explanation 2 to section 11, if money is not received during the current year, it will be deemed application in the previous year. If it will be deemed application in the previous year, but the money once received should be applied in the year of receipt or in the following year. That's what I told you. Non-application or shortfall in application deemed as income of the previous year. Sorry, here you have to make the, here there's a mistake. Here you have to change it. Non-application or shortfall in application deemed as income of the following AY. Following AY to the AY in which income is received. So here we had considered the example of 22-23. Let's say it is not applied in 23-24 as well as in 24-25. So this will be taxed in previous year 24-25. Are we clear? Similarly, income received on the last date, again it will be considered as deemed application, but the amount should be applied in the next year. If not applied, income deemed to be the income of the previous year, here also you make a change. Previous year, following the year in which income is derived. So let's say this will be in previous year 23-24. Clear? And then, as I told you, excess anonymous donation will be taxed at 30% under section 115 BBC. Are there any doubts till now? Is it clear? I have revised everything for you. For those of you who have not revised, I have again revised everything because this is very, very important concept. Okay, I'll take up some question. Another Supreme Court observation on educational institutions. Supreme Court has said tuition fee should be affordable education, not a business to earn profit. Yes, that's correct, Mansha. Whether application of income on actual paid basis is retrospective amendment or prospective amendment. For example, for the previous year 21-22, some expenses are allowed as the application of income on accrual basis, some as paid in previous year 22-23. Is it application of income for previous year 22-23 as well? Purushottam, to my knowledge, it is, I think, prospective amendment only and not a retrospective amendment. Still, I'll check and get back to you regarding that. So I'll immediately check it up. It's not that I'll, because today is the last class. Let me just verify that and reach out to you regarding that whether it is a prospective or it is a retrospective amendment. Okay. So with in the break, I'll let you know about that. ROI should be filed before the due date of, it is 139.1. Purushottam, ROI 139.1. 139.9 is defective return. Every year of its accumulation period or not necessary for the subsequent years as like set off of loss. Is it violation of condition for tax as deemed income? So ROI should be filed each year if your total income exceeds the maximum amount not chargeable to tax without considering section 11 exemption or section 1023C exemption. And you have to file the option for accumulation once, which is before the particular year when you are accumulating. And then you can accumulate for the period of 5 years. Is it hypothetical situation only? What if total donations and anonymous donation is less than 1 lakh rupees? How do you calculate the 5 of total donation or 1 lakh, whichever is higher? So then you do 1 lakh only if it is less than 1 lakh. Let's say, for example, if it is less than 1 lakh, then it is any which ways entirely will be considered as normal donation then, Purushottam. Then we will not have any excess donation. It will be considered as normal donation. So it is excess donation which will be taxed under 115 BBC. So the normal donation, if it is less than 1 lakh, it will be considered as normal donation only, Purushottam. Is that clear? Yes or no? Yes. Are we clear? Okay. Any doubt? Yes or no? Are we fine with this? Yes. Fast, quickly. Okay. So now what I will do is, now we are going to look at the capital gain part, which is again very, very important, which we have not done till now. Okay. So now we are going to look at the capital gain part, which is there. Now in capital gain, let's say, for example, if the reinvestment is made. So what we did is when we were computing the income, so when there is a transfer of a capital asset which is held under wholly for charitable or religious purpose, where the net consideration is now utilized for acquiring a new asset, where the net consideration is used for acquiring the new asset, then the entire amount of the capital gain arising from the transfer would be deemed to have been applied for charitable or religious purpose. So let's say, for example, let's say where entire consideration is invested in new asset, where part consideration is invested in new asset, and where, let's say, excess amount over the consideration or over the capital gain is invested in new asset. Now, let's say, for example, if my sale consideration was, let's say, 5 lakh minus expense on transfer, let's say 1 lakh, 4 lakh. Let's say my indexed cost of acquisition was again, let's say 2 lakh. So 2 lakh is my capital gain. Now, let's say I have invested the entire consideration here, 2 lakh. Let's say here I have invested 1.5 lakh. And let's say here I have invested 3 lakh rupees. Or here, let's say we have invested, 3 lakh. So then how will you compute the capital gain? Yes, tell me. Yes, how will you compute the capital gain in this case? Yes, fast. What will be the answer in the first scenario? Yes, fast. Or let's say, let's make this thing. Let me change the numbers. Let me put it here. Let's say 5 lakh as the sale consideration only and not the capital gain amount. And here I'll make it, let's say 6 lakh. So how will we do it? Nil. In the first case, it will be nil. Because what does the provision say? It says that where the whole of the net consideration from the transfer of a capital asset is utilized for acquiring a new capital asset, which is held under the trust, the entire amount of capital gains arising from the transfer would be deemed to have been applied for charitable or religious purposes. So here, my entire capital gain, which is there, it will be considered as, my application will be considered as 2 lakh. My application will be considered here as 2 lakh. So the exemption which is there, or the application which will be considered under section 11(1)(a) will be 2 lakh rupees full. Okay. Now, where the part consideration is invested. So what does the provision say? If, however, only a part of the net consideration is utilized in acquiring the new capital asset, the amount of capital gains deemed to have been utilized for the charitable or religious purposes shall be equal to the excess of the proceeds utilized over the cost of the asset transferred. So here, my capital gain is 2 lakh, which is there. Right, my capital gain is 2 lakh. So how will you do it here? Will you do it like 54F? Will you do it like 54F? What does the provision say? If the part of the net consideration is utilized in acquiring the new capital asset, the capital gains is deemed to have been utilized will be the excess of the proceeds utilized. So here, application shall be excess of proceeds utilized over the cost of the new asset. Over the cost of the new asset. So will we do it like 54F, where we do the capital gain into the amount invested divided by net sale consideration? What will we do it over here? I'm making this as, let's say, 3 lakh, not 1.5 lakh. Yes, will we do it like 54F? Read the provision and let me know. No, Purushottam, that's not like that. It's not like that. Yes. Yes, fast. Read the provision and let me know what do you think. Yes, yes, yes. I'm giving you 1 minute time. Yes, fast, quick. Is it so difficult? Read it and let me know. Yes. Okay. What does it say? The application shall be the excess of proceeds utilized over the cost of the new asset. It is not saying that you will have to take the proportionate amount. You don't need to do it like 54F. What are the wordings which are used in 54F? What are the wordings which are used in section 54F? If you read 54F, then in that particular case, what does it say? The 54F simply says that subject to the 54F simply says that the amount of net consideration, the amount of the net consideration in proportion to the amount invested, the income which is there under the capital gain, which will be exempt, will be what? The amount of the net consideration which is proportionate to the amount invested. Are we getting that? So if the cost of the new asset is less than the net consideration in respect of the original asset, the capital gain as bears to the whole of the capital gain the same proportion as the cost of the new asset bears to the net consideration. Wordings are used like that under 54F. Whereas here, if you see, the wordings used are what? The wordings used are that the application shall be the excess of the proceeds which are utilized over the cost of the new asset. So that means what? Here, your application will be you will recompute the capital gain. Here, proceeds utilized are 3 lakh. Over the cost of the new asset is what? Sorry, proceeds utilized are how much? Proceeds utilized are how much in this particular case? My proceeds utilized or my net sale consideration is how much? This much, 5 lakh. So my net sale consideration will be 5 lakh, which is the proceeds utilized over the cost of new asset. Over the cost of new asset. Are we getting that? So here what you will do is, here my proceeds which are utilized in this particular case is, proceeds which are utilized is 3 lakh. Proceeds which are utilized is 3 lakh and the cost of the asset is 2 lakh. So 1 lakh will be considered as my application. 1 lakh will be considered as the application of the income. Are we getting that thing? Is there any doubt? What will be in the next case? What will be in the next case? What do you think in the next case scenario? Yes. In the next scenario, how will you do it? The excess amount over the capital gain which is invested. Yes, fast. Think about it and let me know. Yes, fast. So here, in this particular case, the 5 lakh will be considered as application under section 11(1)(a). The 5 years will be considered as the application under section 11(1)(a, and the balance 1 lakh, which is there, will be considered as normal application under section 11. So if you remember this, what I had told you is that capital asset acquired, that is allowed as the application. So even if I have invested more, I will be allowed that. So 5 lakh will be against the capital gain, 1 lakh will be allowed as normal application. Are we getting that? Any doubt? Any question, any doubt? So where the cost of the new asset is greater than the, here you can make the change and write like this so that to avoid confusion. I'll give you a simple point over here where the cost of new asset is greater than the net sale consideration from assets sold. So in that particular case, entire amount is considered as application. Entire amount is considered as application. In this case, you can write down, instead of part consideration, you can also write down cost of new asset is less than the net sale consideration. Cost of the new asset is less than the sale consideration. Then in that particular case, the application shall be the excess of the proceeds utilized. What is the proceeds utilized? The 3 lakh rupees, right? Minus the cost of the old asset. Cost of the new asset minus the cost of the old asset is equal to the amount of the exemption. Are we getting that? So cost of the new asset, which is 3 lakh, minus the cost of the old asset. What are my proceeds utilized? Proceeds utilized are 2 lakh rupees over the cost of the new asset, which is 3 lakh. Are we getting that one? Yes or no? Any questions, any doubts so far? Yes, Purushottam, that's correct. Cost of new asset is not 2 lakh, Kaushiki. Cost of new asset is 3 lakh. 2 lakh is the cost of the old asset. Yes, correct. Yes, yes or no? Fine. There will not be any other exemption under section 54. Fine, fine, fine. Yes, is this particular point clear? Shall we move ahead then? Okay. Yes or no? Yes or no? Are you clear with the capital gain? Yes. Is this clear? Purushottam, the doubt which you had asked regarding that whether the expenditure on the payment basis, whether it is retrospective or prospective amendment, it is a prospective amendment and not a retrospective amendment, as I had told you. Okay. Let's move forward now. Now, what we are going to do, we are done with the application of income and all of that. Now, I'll give you a sum. First, we will solve that particular question. So, let me just download the question and give you. You are going to solve that question and give me the answers. Yes, this is the cost of old asset minus the cost of new asset. Sorry, cost of new asset minus cost of old asset. Fine. Let me just download it. Give me a minute. Just a second. So this was asked in my attempt, and this is how the sum is. Now, please do not ask me which attempt it was. Okay. Yes. A public charitable trust. A public charitable trust registered under section 12AB. Are you able to see the screen? It's read only 1 second. Okay. A public charitable trust registered under section 12AB runs a hospital and also a medical college. Furnishes you the following information for the year ended 31st March 23. Gross receipts from the hospital is rupees 425 lakhs, including the voluntary contribution towards the corpus. Income from business. Income from business incidental to main objective rupees 2 lakh. Voluntary contribution received from public rupees 32 lakh. It includes corpus donation of 3 lakh from another charitable trust and anonymous donation of rupees 5 lakh. Note, voluntary contributions are included in gross receipt given in 1 above. Hospital operational expenses incurred rupees 105 lakh. This does not include the capital expenditure and depreciation. Income from medical college solely for education purpose rupees 10 lakh. Gross receipts of college for the year 100 lakh. Gross receipt given in 1 above includes a sum of 55 lakh which has accrued but not received. Further, a sum of rupees 18 lakh was received only on 31st March 2020. The trust set apart rupees 80 lakh for acquiring a building to expand its hospital, but the amount was paid in December 23 when the sale deed was registered in its name. In June 22, the trust purchased and installed a new computer software for rupees 28 lakh. The rate of depreciation is 40% as per the Income Tax Act. The trust incurred 35 lakh towards purchase of laptop, computers and printers for the hospital. It repaid the loan of 15 lakh taken earlier for the construction of hospital building and donation of rupees 2 lakh towards the corpus to a trust registered under section 1023C and another donation 1 lakh paid by bearer check. Compute the total income for the AY 23-24 in order to avail the maximum benefit. Yes. So as I said, this was given in my attempt and I couldn't solve it properly. I made a small error because it is a very easy question, yet should I upload it now? Give me a moment. I'll upload it now only so that you can solve it. 1 second. I'll upload it now itself so that you can solve this particular question. Meantime, just those who want to solve this, start solving this, can just solve it. Yes, I've uploaded the file. Let me know in case you see it. For those who have not been able to see it, it's already available on the screen. Okay. Yes, Kaushiki, I will upload it by tomorrow. All the notes. This entire book will be uploaded by tomorrow. Please start solving. I remember every bit of this question because I made a small error here and therefore it's still very clear as if I was writing my exam. And I got nervous looking at the size of the question. We'll solve it together, but just have a look at the question. Have you guys received it? I've uploaded. Have you received it at your end? Have you received it? I'm asking something. No, not available on portal, Mansha. Maybe I think they would approve it and then I think they will upload it, possibly. But meantime, you can just look at it. I have uploaded at least from my end. I can see at least it's trust, which I have uploaded the title, which is there. Just have a look once if you are able to see it. Last 2 minutes, because only this much time you will get in your exam. I got even less than that. See, when you are, solving these kind of questions at home, also time yourself that you will not take more than 15 minutes on this question. 15 to 20 minutes max, because otherwise you will have to finish paper. Do not leave the paper. Even if you know something about it, write it. Because the more you will attempt the question, basically you do not have any guarantee whether you have attempted right or wrong. So try to attempt all the questions. At least 90% of the paper you should attempt. Last 1 minute. Shall we solve together? Okay, fine. So gross receipt from hospital, rupees 425 lakh, including the voluntary contribution towards the corpus. What we would do over here? What are we supposed to do here? Tell me quickly. Yes. Should I take 425 lakh as the income from the property held under the trust? The first question is whether this hospital at all will be subject to the exemption. Yes or no? Mansha, you are saying not to be considered because it's a corpus donation. No, that's not the correct answer. Your entire sum will go wrong then. Yes, Mansha, that's correct. Corpus donation has to be excluded. Can you guys be a little helpful to me in terms of giving me the figures rather than the answers? Yes, Purushottam. 425 lakh minus 3 lakh. What is 3 lakh, Purushottam? What is 3 lakh and minus 29 lakh? What do you mean by 3 and 29? Yes, guys, please be a little helpful to me to give me the figures because you have to calculate now. I have to just write what you are saying and be a little fast. And all of you have to participate. I do not want any student to be sitting quiet. Give wrong answers so that you do not give the wrong answers in the exam. Corpus donation and voluntary donations respectively. So corpus is voluntary contribution from received from public is 32 and corpus donation is of 3 lakh. So you are excluding both, right? From the gross receipts. Yes, Purushottam. So what is the answer? 393 lakh. That's correct. So we'll write down here. Gross receipts from hospital. This is my particulars. And this is my amount in rupees. Okay. So gross receipts from hospital, which is there, is rupees 425 lakh minus the voluntary contribution, which is 29 lakh minus the corpus donation of 3 lakh. So this will give me rupees 393 lakh. What we have to do next? What we have to do next? Income from business incidental to the main objects, rupees 2 lakh. Yes. Income from business. Yes, Mansha, you are correct. Income from business. Rupees 2 lakh. Guys, be very, very fast. Before I'm writing, you should be thinking about the next point because we have to do a lot today. Otherwise, I'm going to extend till 10 o'clock, okay? So be very quick. I need answers from all, fast. Yes, Purushottam, incidental business, we will add, this is less than 20% of the total receipts. And this is incidental to the main objective. But here the question arises whether we will consider here the object of advancement of general public utility over here. So whether we will put that 20% criteria here, the question is that whether you are going to put the 20% criteria over here, advancement of the object of general public utility. Yes, whether we are going to consider that 20% criteria. No, Kaushiki. Why no? Mansha, you have said less than 20% of income, but whether at the first place, will you consider that criteria? Fast. Quick, guys. I need answers from all of you. Not many students are replying. Only Mansha and Purushottam are answering. Jacob, what about you? Anarkha? No. Okay. Why we will not consider? You are giving me yes or no, but why? What is the reason? You will not write in your exam, just it will not be considered. But you have to give the reason. Examiner is looking for a reason. Guys, fast. Based on new noble? No, new noble was for educational, Kaushiki. That's why I said reasoning is very important. New noble was in the context of educational. Here we are looking at the medical. And this is incidental to the objective of the medical. So why we will not consider? Because it is not a charitable purpose. No, Purushottam, this is a charitable purpose. Who said it's not a charitable purpose? What is the definition of charitable purpose? If you see, relief to poor, education, yoga, medical relief. So medical relief is considered as a separate objective. So hospital will fall within here. Medical relief. So you will not consider 20% criteria, because 20% criteria is for advancement of any other object of general public utility. I will not consider that criteria. Remember, yesterday only I told you, if my relief to poor is objective and I have the trading receipt of rupees 30 lakh, if it is incidental to the object of relief to poor, then even if it exceeds 20%, I will still allow the benefit. So here also, the 20% proviso is not applicable, because it is medical relief and not falling in the advancement of any other object of general public utility. Are you getting me, guys? Yes. So therefore, we will not consider that 20% criteria. What we will just say is that this is incidental to the main objective. And if you look at the Ahmedabad development trust case which was there, so in that particular case, if it is incidental to the main objective, you will give the exemption. Okay. So business income incidental to the main object. You will write down here, since it is incidental to main object and assuming separate books of accounts are maintained. So for the incidental business income, you need to maintain the separate books of accounts. You need to maintain the separate books of accounts, and therefore in that particular case, what you will write is, therefore this will be considered as the income which is allowed. Okay, so here there will not be any problem. Are we clear? Yes or no? Yes or no? So any activity which is incidental to the main objective will not result in any problem. Clear? It is only if it is in the advancement of the general public utility, it will not be considered for the charitable purpose. So a charitable trust engaged in the business activity provides that the section 11 provides that the exemption under the regime would be available in respect of income, which is the business income, if such business is incidental to the attainment of the object and separate books of accounts are maintained. Okay? And separate books of accounts are maintained. You will write here for yourself, here 20% limit to advance to the gross receipts is not applicable as medical relief is charitable activity in itself and does not fall into object of general public utility. Fine. Are we clear? Okay. Next. Voluntary contribution received from the public 32 lakh. It includes the corpus donation of 3 lakh from another charitable trust and anonymous donation of 5 lakh. So how much voluntary contribution I will have to consider over here? Voluntary contribution. Here in exam, I was also confused. What is your answer? Because when you are, reading so many provision, you are revising your entire DT together, it is bound to get confused in exam. Why we have not included voluntary contribution of 29? Because we are including over here. So this is the presentation. This is how you make the presentation, Kaushiki. You could have included there, but there I am just including the gross receipts from the hospital. Yes, how much is the voluntary contribution? Fast, fast, fast. Yes, Viraj. How much is the voluntary contribution? Mm. 29 lakh? No, not 29 lakh, Jacob. You will not consider 29 lakh? Yes. Okay, yes, because here it includes the corpus donation as well as the anonymous donation of rupees 5 lakh. So here it includes the corpus as well as anonymous. So you will not include 29 lakhs, Purushottam. Because the question is clearly saying you cannot take that view that it is not including the anonymous donation of 5 lakh. Voluntary contribution from public is 32. It includes the corpus and the AD. So how can you take 29? Yes, Kaushiki, 24 is the correct answer. Voluntary 32 will exclude 3 lakh because 3 lakh are not for specific purpose. No, because 3 lakh is mansha for the corpus. So that's why you will exclude it. It's not for the specific purpose. You will not write like that. You will say because it is for the corpus. Yes, Jacob, it's 24. Voluntary is then 29 minus 5, 24. Yes, correct. So here I will take voluntary as 32 minus 3 of corpus minus 5 of AD. So it is 29 lakh. Clear? Then anonymous donation. 5% of total donation or rupees 1 lakh, whichever is higher. Give me the amount. Give me the amount. No, Purushottam, that's not the correct answer. Yes, Kaushiki, that's the correct answer. So how will we do it over here? What is the 5% of the total donation? What are my total donation over here? How much will I consider as the total donation? What is the 5% of total donation which is there? So my total donations, if you see, will I consider the gross receipts in the total donation? Will I consider the gross receipts under the total donation? Yes or no? Will I consider the gross receipts under the total donation? No, Jacob? Yes, Purushottam, you're correct. So will I consider the gross receipts first? No, we will not consider the gross receipts. Yes, Kaushiki. Gross receipts are not the donations. These are the receipts. Income from business, whether it is donation, the answer is no. Yes, Jacob, correct. So income from business is not donation. Kaushiki, you are correct. Total donation includes the voluntary, corpus and anonymous. So directly of 32 lakh, you will do the 5%. Yes, correct, Kaushiki. So 32 lakh into 5%. Jacob, what mistake did you make here? How did you get 25,000? So 5% of total donation means 32 lakh. Because what I have received here as the donation amount is the voluntary contribution 32. It includes the corpus as well as anonymous. So 32 lakh, 5% or rupees 1 lakh. The higher is 1.6 lakh. So here 1.6 lakh which is there is considered here as the normal donation because 3.4 lakh is considered as the excess donation. Clear? Next, what do you consider? Okay, next, let's see what it says. Hospital operational expenses incurred 105 lakh. This does not include capex and depreciation. So this I'll let it remain here because this any which ways we are going to consider after the 15% part. We are going to consider after the 15% part. Income from medical college solely for educational purpose, rupees 10 lakh. Gross receipts of the college for the year is rupees 100 lakhs. Yes. What you will do over here? Okay, Jacob. Yes, give me the answer over here. You will take Vansha gross receipt. What is the reason you will take the gross receipts over here? You will take the gross receipts over here. Jacob, why you will take 10 lakh? Yes, Kaushiki, correct. Yes, Purushottam. So here we are going to get the exemption under section 1023C. But why do you think we will get the exemption? What is the limit for exemption under 1023C? For the 1023C, the limit which is there is how much? For 1023C, it is how much? Less than rupees 5 crore. Is it less than rupees 5 crore? Yes. It is less than rupees 5 crore. 100 lakhs, sorry. It is 100 lakh, not less than rupees 5 crore. What is 100 lakhs? 100 lakhs is how much? It is 1 CR, isn't it? So it is less than rupees 5 lakh. So in that particular case, it will be considered entirely as exempt. So if my entire gross receipts from the university or institution existing solely for educational purpose is less than rupees 5 crore, then in that particular case, it will be entirely exempt, isn't it? So, yes, so both are together. No, Purushottam. Understand one thing. The hospital is registered under 12AB. The hospital is registered under 12AB. Yes, Purushottam, I know 100 lakhs equal to a crore, but hospital is under 12AB. So that is a different scheme. What we are talking about here is, here we are talking about the hospital, educational institution, which is registered under 1023C. So therefore, it is not exceeding 5 crore. And therefore, we will consider this as exempt. We will consider this as exempt. Are we getting that? This will be exempt in a will. Fine? Yes. If it would have been more than 5 crore, then you would have taken it for sure. Okay? Okay? Any doubt? Yes? Okay. Next is gross receipt given in one above includes a sum of rupees 55 lakh which has accrued but not received. Further, a sum of rupees 18 lakh was received only on 31st day of March 2020. But what here we will do is we'll pause here for a moment and we'll take the total of these income, and after this we will apply 15%. Why? You will apply here 15%. Give me the total amount. What is it coming to? Yes, Purushottam. It is 420.6. No, Kaushik, it is not 420.6. How 420.6? Okay. 1 second. It's my calculation error. Let me calculate. 393 plus 29 plus 1.6. Yes, 423.6. That's correct. You're right, Kaushiki. What is the 15%? Less 15% of income eligible for accumulation or being set apart without any condition. Without any condition. What is 15% coming to? What is 15% which is coming to? Oh, I have not written over here. Yes, thank you, Kaushiki. So then we will have to add 2 lakh also. It is 425.6 and not 423 because business income only Kaushiki remembered. We all forgot. Isn't it, Kaushiki? It is 425.6, right? Yes, confirm what is the 15% coming to? Yes, voluntary income is also 24 lakh. Sorry, Kaushiki. I'm still making the mistakes even after my exam. But I'm hoping that you will not make. 420.6 is correct. Yes, minus 15%. 357.51. This is 420.6. Plus 15%, it comes to 357.51. Okay. Yes. Now let's move to the application part. Hospital operational expenses incurred 105 lakh. This is pretty simple. Less hospital operational expense. How much it is? 105 lakh. Fine. The trust set apart 80 lakhs for acquiring a building to, this is there. Gross receipt given in one above includes a sum of 55 lakh, which was accrued but not received. Further, a sum of rupees 18 lakh was received on 31st day of March 23. It should not be 2020, it should be 23. Yes. What will you do in this case? Deemed application, yes, Purushottam, that's correct. So reduce it. So what we will do here is less deemed application. Income accrued but not received. And second is income received during last day of previous year. But here you will write a note. What note you will write? It is assumed that an option is exercised in Form 10 before the due date of filing return of income under section 139(1) to treat such income as deemed application in the previous year in which it is received. I had forgotten to write this note, so that is not correct. You should be writing your notes. Okay? Otherwise, you will lose out on points. So what is it? 55 lakh and 18 lakh. Okay? Do not forget to write the note. Fine. Next. The trust set apart 80 lakh for acquiring a building, but the amount was paid in December 2023 when sale deed was registered in its name. Yes. No, Purushottam. Think about it properly. Yes, Kaushiki. This is an inadmissible application. It is not only the expenditure as well as the any amount which is payable. So here you can write down, instead of expenditure, you can write down any amount payable. You can write down over here what we have written as inadmissible, any amount payable but not paid is inadmissible in nature. So it's not just expenditure, but even any other amount. Similarly, here also you can write expense or application. Expense or any application. Are we getting that? Okay. So any amount which is not paid in this particular case, this amount has been set aside. It has been set apart, but the amount has not been paid. So therefore, in that situation, you will not get the particular application. Are we getting that? So any sum payable shall be treated as application of income only in the year in which it is actually paid. Clear? So it's not just the application, but any amount, because the act is very, very clear. It says any sum payable by the trust shall be considered as application in the year in which it is actually paid by it. Are we clear? Fine. Okay. So write it down over here. You can write down over here. The amount set apart for acquisition of building. Amount set apart for the acquisition of building would not be considered as application unless it has been actually paid. The amount would be allowed in the previous year 23-24. It will be allowed in the previous year 23-24. Clear? Okay, next one. In June 22, the trust purchased and installed a new computer software for 28 lakh. The rate of depreciation is 40%. Yes. Also in this case, if you see, you may ask a question back, but it has set apart. Okay. In this case, if you see, he has set apart the particular income. 80 lakhs, right? But here there is no information is given. Here, if you see, there is no information given that he has filed the form 10. So here you will assume that he has not filed form 10 also. So it is assumed. You will write here, 1 second. You will write over here, it is assumed that he has not filed form 10. In case he would have filed form 10 and he would have said, okay, I'm accumulating and setting apart, then it would have been considered as deemed application. So if you're filing form 10 and then accumulating or setting apart, then it is considered as deemed application. But where you are not filing form 10, then in the year of payment, application is allowed. Okay. Fine. Yes, what you will do in the second case? Computer. Computer is not a capital asset as per the definition. So depreciation, no, it is a capital asset, computer. Yes, Jacob, depreciation is inadmissible. Purushottam, computer is a capital asset. PGBP. Yes, Kaushiki. Yes, Mansha. Correct, correct. Okay. So here what we will do is computer less computer depreciation not allowed. So how much is the computer for? It is for how much? Computer is for 28 lakhs. So I'll consider here 28. Next is the trust incurred 35 lakhs on the purchase of laptop, computer and printers for the hospital. So again that I will allow less laptops and all of that. Okay. So 35 lakh. That also I will allow. Then it repaid the loan of 15 lakh towards the taken earlier for construction of hospital building. No, Purushottam, it is not for the difficulty. Form 10 is for setting aside or accumulating the income or exercising the option that if the income is received in the previous year on the last day or in the year in which or the income is not received during the year but it has been accrued. Form 10 is for that. If you remember, we have done Form 10 here in the last class. See, where did Form 10 go? Where did I write it? Yeah, see, accumulation of income. Form 10 and ROI need to be filed. Similarly, for the deemed application, again you have to file Form 10. Clear? Here also you can write down for the any amount payable but not paid is considered as inadmissible unless you can write down Form 10 is filed to set apart. Okay? Yes. What about repayment of loan? It is admissible. So repayment of loan is admissible. Yes, correct. So here what we will do is repayment of loan less how much it was? 15 lakh. Last one. Donation of 2 lakh paid towards the corpus to a trust registered under 1023C and another donation of 1 lakh paid by bearer check. Yes. Pass, what you will do? Yes, not allowed for the corpus of trust. What about the donation which is there? What about the donation which is there in the bearer check form? Whether that will be allowed or not? Yes. Past. Whether donations will be allowed or not for the bearer check. I'm not getting answers very quickly. Yes or no? Okay. See, most of both not allowed, assuming not to 12 AB trust. Okay, not allowed. Bearer check donation not allowed. Okay. See, there are two views to it. I'll tell you what. First is very clear. Donation towards corpus of another trust is not allowed as application. Clear? Also, donation which is paid otherwise than by way of an account paid check or demand draft will not be considered as the eligible application. That's view one. View two is that the donation which is paid is not an expenditure, and 40A3 applies only to the expenditure. So 40A3 technically only applies to the expenditure and not to the donation. Donation per se is not an expenditure. It is just an application of income. Only when you are doing the operational expenses on that you will apply 40A3. So you can write the alternative view in exam. If you say that 40A3 is, so two views, 40A3 applies to donation and therefore not considered as application. The second view you can write here is, this is view 1 and view 2. 40A3 is not applicable to donation but only to expenditure and therefore allowed. Ideally, it should be this view, view 1. You should not allow that, okay? Because that is how the intention of the law is, not to allow even the cash application for donation. It should not be interpreted literally, it should be interpreted purposely. So I will not consider over here. Now some variations which are not there as a part of question, but I would like to discuss with you because that will make it all the more comprehensive and will consider all the possibility. Let's say, for example, in this operational expense, let's say there is salary to medical staff. Salary to medical staff which is there, on which TDS is not deducted. On which TDS is not deducted. Then what you will do? Salary to medical staff, let's assume it is how much? Rupees 20 lakh. So what you will do in this case? Yes, Purushottam, you can opt for both the view, but you have to see the intention of the legislature. Yes, 30% will be disallowed. How much is 30%? How much is the 30%? Yes. How much will 30% come to, Mansha? Yes, how much? 6 lakh. Okay. So what we will do it here, let's say for example, if this was my question, then while I'm considering the operational expenses, I'm just making a variation over here, 105 lakh minus 6 lakh. So this will give me how much? 105 minus 6 is 99 lakhs. Okay. So then this would have been 99 lakhs. Fine. That's the first adjustment I just wanted to discuss with you. Second is, let's say for example, I'll add a point over here. Let's say the building was sold. The building was sold for rupees 10 lakh. It was purchased in 2012-13 for rupees 4.5 lakh. Another building was purchased for rupees 13 lakh. Yes, what you will do in this case? What you will do in this case? Fast. How much will be your capital gain? Yes, fast. %30 is disallowed, Jacob. Okay, consider here, yes, Purushottam, consider index cost of acquisition as 4.5 lakh. This is index cost of acquisition only. Index cost of acquisition is 4.5 lakh. Let's assume for simplicity like that. But how much is CG, Kaushiki? See, in this case, what is my CG? It is 5.5 lakh, isn't it? 10 lakh minus 4.5 lakh. My CG is 5.5 lakh. Now, this 5.5 lakh we are going to consider where? So we will add this here as a fifth point. Capital gain 10 lakh minus 4.5 lakh. This will be my capital gain over here, which is how much? 5.5 lakh. So this will change 420 plus how much will it come? 420.6 plus 5.5, 426.1. So this will become 426.1, and after 15% it will become 362.185. 362.185. Okay, and then here we will consider as amount invested is how much? Amount invested is 13 lakh, which is more than the sale consideration, right? So in this particular case, the entire amount will be allowed. Okay. Now what will be? This will give me my total income. Sorry, this will not give me my total income. What is my total income? Calculate for me. This will still not give me total income. What is my total income? And then we shall take a break. What is my total income? Calculate the total income for me. What is the total income coming to? Yes, Kaushiki. We also need to consider the, yes, Mansha, excess donation. How much was the excess donation? No, it was not 0.25. Here, I forgot this in my exam, and this was the total income computation, and I lost my marks because of that. So anonymous donation, what was the anonymous donation? 5 lakh minus how much we have considered over there? 1.6 lakh. So 3.4 lakh is the anonymous donation. You will add it over here because this is going to be taxed as 30%. So 102.585 will be my total income. Yes, yes, Mansha, correct. Now, are you still fearful of charitable trust? Yes. Are you still fearful of charitable trust? I hope you are not. You can solve this question and expect a question in the exam. Okay? Yes or no? Is it clear? I hope I have made it very simple for you. Yes, Kaushiki, deemed application, what you have doubt? Please put your doubt. And let's take a break of 5 minutes. I'll answer your question, Kaushiki, after the break. You can put the doubt. 5 minutes break. Yes, Purushottam, you will have to solve many times to, be very safe with it. In the class, you understand, but then when you solve at home, you again recollect so many new points. Okay. Okay, let's take a break of 5 minutes. We get back in 5 minutes and we are going to extend the class. Yes, Kaushiki, I'll explain the deemed income again after the break. Okay. So let's take a break of 5. Kaushiki, if we don't exercise the option in Form 10, then that will not be considered as deemed accrual. Deemed application. Yes, then it will be like the cash basis only, that you will get the application in the year in which you are making it, or you are receiving your income, and plus it will be taxed then. So see, if you are not filing Form 10, then it will not be considered as deemed application. Then that income will get taxed in the hands of the trust. We invested section 1015. Then income from these assets will be interest on tax-free certificate. No, if you are doing it under 1015, we'll come to that point, Mansha. Wait for it. Okay, Kaushik, you're clear about deemed application? Very good. Okay, let's get started fast. Okay. Now, what we need to do is, okay. Give me a second. Okay. See, now what we are going to start with is the registration requirement. But before that, what we will do is registration and cancellation is the procedural part that I'll quickly get you run from the module. But what is more important here is the section 13 violations which are given up. That's what we have to first consider. Okay. So let's get quickly started. Okay. So Kaushiki, for your benefit, what I'll do is I'll repeat the deemed application once. So what is deemed application? Deemed application means that, let's say, for example, if you have the income, fine. Or I can write it over here. Deemed application. One is in respect of accumulated amount. Right? One is in respect of the accumulated amount. If I have received the income and I am accumulating it, okay, I am accumulating it for a period of less than 5 years, or 5 years is the maximum time limit, okay, 5 years or less, then that will be considered as deemed application. Second is income received at the end of the previous year. At the end of the previous year. And next is income accrued but not received. Income accrued and not received. Now this will not be considered. This will not be considered as income deemed application. Are we getting that? So this will be considered as deemed application. For both of this, you will have to file Form 10. You will have to file Form 10. Are we clear? Are we clear? Okay. So you will have to file Form 10 in that particular case. Next is, now we will consider very important part over here. So understand one thing. When this will be, let's say for example, this is deemed application, but both of these are having the condition. The condition is what? The condition is that if it is not applied, then in that particular case, it will be considered as the income of the year. In this case, in the year in which the amount is received, the year following that year. So the year following the year of receipt, in that year, it will be deemed application work. Are we clear? Are you clear, Kaushiki, about this? Yes or no? Yes? Okay. Next is, now understand one thing. Section 13, violations. Now, let's try and understand about this. Okay. Now, what does section 13 says? Now, section 13 has been amended for your particular attempt. And what does it provide? And now there is a new scheme, which is new scheme of tax, which has been brought up. What is that? Let's try and understand. So now we'll be spending at least 15-20 minutes on this particular portion about section 13. Now, section 13 basically talks about different kind of violations. Section 13 talks about the different kind of violation. And one such violation is that in a case of this accumulated income, in the case of this accumulated income which is there, now it talks about that particular point. It talks about that particular point. Now, understand very carefully what are the situations in which the 13 becomes the applicable. 13 becomes applicable. Okay. First situation, the income from the property. The income from the property held under a trust is for private religious purpose. So, first is income held for private religious purpose. A. So where the income is applied for a private religious purpose. What is private religious purpose? Let's say, for example, let's say I have a community. I am applying that particular, the trust is established for the benefit of any particular religious community. And it's not a generic trust which is established. So then in that particular case, the exemption will not be given. So where the income which is there is applied for either the private religious purpose, let's say, for example, let's say Tamilians have some festival. And I have started the trust for that. Then in that case, and it is not open to all. It is only open to, let's say, the Tamil population which is there. Or likewise for any other religion, right? So any part of the income that is held for a private religious trust or which is for a particular religious community or caste. Then in that particular case, it will not be considered as the trust to which the section 11 will become applicable. Are we getting that? However, if a trust is, let's say, established for scheduled castes, scheduled tribes, and in that particular case, that will not be considered as a trust which is for a particular religious community. So excluding trust for scheduled caste or scheduled tribes. Okay, that is not considered as for the private religious purpose. Next one in this case is, next violation which is there is, so in this case you will not be eligible for exemption under section 11 or 12, resulting in non-application of section 11 and section 12. Okay. Or there is a trust which is for the benefit of a particular person. So where the income of the trust is for the benefit of a particular person. Now this is very, very important. Income of the trust for a particular income of a trust for the benefit of a related party, or let's write for a benefit of related person, for the benefit of the related person, then that part of income shall not be eligible for exemption. So that part of. So it's not that the entire trust will not get exemption. Part of the income not eligible for exemption. That part of the income is not eligible for the exemption. Are we getting that? So we will not get the exemption which is there on the income which is applied for the benefit of a particular person. So the part of income, only such part of income will not be eligible. It's not that the entire trust will lose the exemption. So entire trust will not lose exemption. Only such part of income will not be eligible for section 11. Are we clear? That's the one implication. The second implication we are going to understand in a meantime. But first we'll see what are the violations. Okay. Then, then the next is deposit or, this is also important, deposit or investment of funds. Deposit or investment of funds in impermissible modes. In impermissible modes. Let me leave a space over here so that, because this is going to be lengthy one, the other implication. Okay. So deposit or investment of funds in mode other than section 11.5. In modes other than section 11.5. If the funds are invested in the modes other than section 11.5, then in that particular case, it will not be considered for the exemption under section 11. Then it will not be considered for the purpose of exemption under section 11. Are we getting that? Any doubt till now? Any question? So if the income is not invested, which income? The income from the property held under the trust. Income from property held under the trust. Are we getting that? So if it is, let's say, business income, if it is, let's say, business income, so to that, this will not apply. This restriction will be not applicable. If it is a business income, this restriction will not be applicable. So if it is PGBP income, this restriction is not applicable. However, where a trust has income from the property held under the trust and the business income is incidental thereto, then in that particular case, this particular exemption will be applicable. So you can either write over here on the income from property held under trust, because any which ways the business income is not eligible for exemption under section 11, plus incidental business income. Okay. Are we clear? Now understand here one particular thing. Where the income or any property of the trust is used or applied directly for the benefit of any person, which is a related person, then in that particular case, the exemption will be denied only to the extent of the income, only to the extent of such income. It's not that that entire income will be denied at the exemption, only to the extent of such income. Are we getting that? So only to the extent of such income, the exemption will get denied. The exemption will get denied only to the extent of such particular income. Clear? Yes or no? Is this particular point clear? Similarly, if the amount are deposited in the modes other than section 11.5, there also the income to the extent of the such deposits will not be eligible for exemption. Income to the extent of such deposits will not be eligible for exemption. Will not be eligible for exemption. Is this clear till now? Any doubt, any question till now? Yes? Any question, any doubt? Who is the related person? Now let's try and understand. Who is the related person? The related persons are the settler of the trust or the founder of the trust. Okay, you can write down over here who is the related person. We are coming back to this point. So related person means author of trust, author of the trust, any person who has made the substantial contribution to the trust, which is more than 50,000. Substantial contributor of trust greater than rupees 50,000. Any HUF or member of the family of author or founder, so author of trust or his HUF or family, you can write it over here only. Trustee of the trust, any relative which I said of the founder or any trustee, any concern in which these persons have the interest. Relative of such person or concern in which they have substantial interest. Relative means the spouse, the brother, sister of the spouse. Okay. Any lineal ascendant, lineal descendant. And what is the meaning of substantial interest? The substantial interest means that there is an interest of more than 20% or more of the voting power. So, greater than 20% of voting power, where it is a company. And where it is not a company, so 20% or more of the share in the profit. Okay. So that is what we mean by the substantial interest. Are we getting that? Now understand one thing. Let's try and understand what are the implications when I make the payment to the related party. When I make the payments to the related party, what are the implications over here? The one implication what we wrote over here is that such part of income will not be eligible for the exemption. So 1 second, let me bring it down. Okay. This is in the hands of the trust. First implication is losing out exemption under section 11. Losing out the exemption under section 11. Okay, that's the first implication. The second implication which is going to be there is that such income which is there would be taxable under section 115 BPI. Now this is a new section at the rate of 30%. So this income will not only be eligible for that, so you will not be allowed any expenditure against that income. You will not be allowed any expenditure against that income, including the 15% ad hoc expenditure. So that is, no expense is allowed, including the ad hoc 15% application. Because this is a provision which is notwithstanding any other provision in the Act. This is a non-obstant clause. So specified income here means income accumulated or set apart, where such accumulation is not allowed, or in this particular case which is there, the income which is deemed to be the income under section 30. Under section 30. Okay. Next implication which is there is, next implication which is arising is penalty under section 271 AAE. Penalty under section 271 AAE. If it is found that any trust is applying the income for the benefit of any person, then the AO may direct the penalty, which is 100% of the income applied, 100% of the income applied, if it is the first time, if it is noticed for the first time. If it is subsequently done, subsequent violation, then in that particular case, 200% of income applied. 200% of the income applied. Are we getting that? So there will be penalty. Yes, Kaushiki, exemption means the admissible, not the admissible application, but it is exempt. Okay, these income are exempt if you make the application, but here this will not be considered as application of income. No, not 15% ad hoc exemption. It means the application, it will not be considered. Yes, Geeta, I will explain 115 BBI again. But first, let me just go with the flow. So, if the trust is making the application of income, for the benefit of related person, then it will lose out the exemption under section 11. It will not be considered as the application. Part of that income is not eligible for exemption. That means it will be included in the income, right? Entire trust will not lose the exemption, only that part of income. The income is taxable under 115BBI at the rate of 30%, meaning you will not be allowed any expenditure against that income, plus 15% ad hoc application will also not be considered. So just like the anonymous, excess anonymous donation, how do you tax it? Do you consider the application for 15%? You don't consider. You only consider the normal anonymous donation for the purpose of 15%. Rest you had included in the end, in the earlier question also. In the earlier question, what we did? We added the anonymous donation at the end, the excess anonymous donation. Why? Because this is taxed at flat 30%. This will not be considered for the 15% ad hoc exemption. Okay, so even this is going to be taxed like that. These are special provision. Plus there will be penalty under section 271 AAE. If it is noticed for the first time, then 100%. If it is subsequent violation, then it is 200% of the income applied. Now this is the consequence for the trust. For the recipient, related person, there is also a consequence. And what is the consequence for that person? What is the consequence for that person? For that person, the consequence is, so if you remember, section 56 to 10, section 56 to 10. What was 56 to 10? What was 56 to 10? Yes. 56 to 10, what was it? Yes, fast. Gifts above 50,000. Yes. And what was that? Yes, fast. FMV greater than consideration. Yes. So if you remember, under the exception to 56 to 10, income from other sources. I don't know if you remember now, but let me take you there. There were certain exceptions to the 56 to 10 not applicability. Receipt from any trust or institution registered under 12A, 12AA, 12AB. So let's say for example, here, let's say if one trust, let's say trust A donates, let's say the paintings to trust B registered under section 12AB for rupees 5 lakh. The fair market value was rupees, let's say 7 lakh. Now this will not be considered for the purpose of 56 to 10 is not applicable. Plus for trust A, this will be considered as the application of income. This will be considered as application of income. For trust B, 56 to 10 is not applicable. But here in this case, if the income of the trust is for the benefit of the related person, then in that particular case, 56(2)(10) will become applicable. 56(2)(10) will become applicable. Are we clear about this? Any doubt? Did you understand? Yes or no? Fast? Clear? Yes or no? Yes or no? Fast? Okay. So now understand one more thing. Now there are other kind of disallowances which are also there as a part of or which is taxed under 115 BBI. Now this is just one part which I told you which is taxed under 115 BBI. But there are other parts also which are taxed under 115 BBI. And what is that? Let's try and understand. So 115 BBI which is there is just not applicable only on this particular portion. It is applicable on several other instances. And what is that? Let's say, for example, 115 BBI. Let's come here now. What are the instances in which it is applicable? Number one, income accumulated. Income accumulated in excess of 15%, where such accumulation is not allowed under specific provision of the Act. Income accumulated in excess of 15% of the 15%, where the accumulation is not allowed under the specific provision of the Act. Now, what does this mean? Let's try and understand. This is in relation to the accumulation. If you notice here, this is in relation to accumulation. What did I tell you about the accumulation? For accumulation, I told you one simple thing. That you get an option. You get an option. What option do you have? Accumulate for 5 years or less by filing Form 10. Accumulate for 5 years or less by filing Form 10. Right, this is the option you have it. Now, let's say, for example, my total income or my gross receipts, let's say, 100 lakhs. Total income, or let's not write total income. Let's say my receipts minus receipts net of expenditure, let's say, is rupees 20 lakhs. Let's say is rupees 20 lakh. Now, out of this 20 lakh, less, let's say 15% ad hoc exemption. Ad hoc exemption of 15% which is there, right? Now, how much is the ad hoc exemption of 15% on this 20 lakh? 3 lakh. So 17 lakh is the income which is available to me. right? Let's say the income which is applied for charitable purposes. Income which is applied for charitable purposes. Let's say the income which is applied for charitable purposes is, let's say, 7 lakh. Less accumulated for 3 years. Less accumulated for 3 years, let's say, again, 7 lakh. So how much is the income remaining? 3 lakhs. Now this 3 lakh which is not accumulated, therefore in that situation this will be considered as the specified income. This will be taxed at the rate of 30%. This will be taxed at the rate of 30%. So income accumulated in excess of 15%, where such accumulation is not allowed under the specific provision of the Act. Or let's say, for example, this income I have accumulated in the modes not specified under the Act. That is not under section 11(5). So even in that case, in this particular case, this income will be taxed as the specific income to be taxed under section 115 BBI. This will be taxed under section 115 BBI. Are we getting that? So if the income is exempt to the extent it is applied, right? Income is exempt to the extent it is applied, which will also, we will consider the deemed application in case I am accumulating the income. Then if I'm not accumulating the entire income and I'm accumulating certain portion of income only, or I'm not applying the income or not accumulating the income in the mode specified under section 11(5), then it will be considered as specific income to be taxed under section 115 BBI. Are we clear? Any question, any doubt? Yes or no? Is this clear? Yes? Yes or no? Yes or no? Fast? Yes? Okay. Next one is, next specified category of income. The deemed income on account of violation of the conditions. The deemed income which is there on account of the violation of the condition which are given under section 11. Which are given under section 11. And what are those conditions? What are the conditions which are there? The condition which is there is, let's say for example, we go back to this particular point. This point. This is section 11(3). This is section 11(3). What does it say? That if the income is applied for other than charitable or religious purposes, or ceases to be accumulated or set apart, or it ceases to remain invested, or is not utilized for the purpose for which it is accumulated, or it is not utilized or it is accumulated, right? Then in that particular case, or it is credited or paid to any trust or institution, is paid to any other trust or institution, then in that particular case, which income is this? This is the accumulated income. Again, we are talking about the accumulated income. We are not talking about the general income. We are talking about the accumulated income. Then in that particular case, this will be considered as the specified income. So here, this will be considered as specified income. So in case of the violation, this is deemed to be the income of the previous year and violation takes place. As far as this income is concerned, which is not utilized or which is not accumulated, then in the last period, it is deemed to be the income. But here, this will be considered as specified income to be taxed under section 115 BBI at the rate of 30%. So this will be taxed under 115 BBI. Are we clear? So this is section 11(3). So the conditions of accumulated income are violated. Conditions of accumulated income are violated under section 11(3). What are the conditions? I'll write down the conditions for you. What are the conditions? It is applied for other than or charitable, religious or charitable purpose. This is for accumulated income, right? Understand this very carefully. Applied for charitable or religious purposes. Sorry, other than charitable or religious purposes. Right? Ceases to remain invested or is not utilized for the purpose, not utilized for the purpose for which it is accumulated, then paid to any other trust. Paid to any other trust registered under 12AA or 12AB. Right? So therefore, in that case, it will be considered as 115 BBI specified income to be taxed under at the rate of 30%. The first one was income accumulated in excess of the 15%, which is accumulated where such accumulation is not allowed under the specific provision of the Act. Are we getting that? Second is the income is accumulated, but it is not applied for charitable, it is applied for other than charitable or religious purpose. It ceases to remain invested, or it is not utilized for the purpose for which it is accumulated, or it is paid to any other trust or registered under section 12AB. Now what I'll do is I'll take this at the end so that I have to make it a very comprehensive point over here so that you can remember while revising for your exam. For this, you can write down deemed to be income in the year of violation. For this, you can write down deemed to be income of the 5th year or last year. So let's say, for example, if I have the, let's say, income from the trust, again, let's take the simple example, 20 lakh. right? Less ad hoc exemption. This is example 1. This is example 2. Less ad hoc exemption 3 lakh, right? 17 lakh. Now here I have income which is applied, let's say 7 lakh. Let's say accumulated for 3 years. Now out of this 7 lakh which is there, let's say for charitable or religious purpose, I have not applied, let's say the income of rupees 2 lakh not applied for charitable purpose. 1 lakh donated to other trust. And rest, let's say out of 7 lakh, this is 3 lakh. So 4 lakh, this is accumulated. 4 lakh accumulated. This is previous year 22-23. But in 24-25, not utilized. So this will be considered as the income of the current year. This will be considered 3 lakh will not be considered as application. This will not be considered as application first of all, right? And this will be income of previous year 22-23 when the violation takes place, taxed at 30%. This 4 lakh I will allow. This 4 lakh I will allow. So 7 plus 4, 11, 11 and 17, 6 lakh will be my income. Now this 4 lakh which is allowed, this will be again taxed in previous year 24-25 at the rate of 30%. Are we clear about this? Any doubt? Any questions? Yes. Yes, Kaushiki, 15% indefinitely allowed, balance max 5 years. You can accumulate. It's not that it will not be allowed. You can accumulate for 5 years. Yes, Geeta. So while computing the trust income, at the end of the computation, you will take this income just like anonymous donation. Yes, Kaushiki, this specified income also includes the income not utilized after 5 years. So this is what I've said. Not utilized for the purpose for which it is accumulated. Okay? Yes, clear? Third is the deemed income. Third is deemed income under section 11(1)(b). What is 11(1)(b)? Yes, what was 11(1)(b)? So 11(1)(b), which is there, if you remember, what was it? 11(1)(b) was regarding, yes, was regarding the income which is not received during the year or which is accrued, sorry, income which is received on the last day of the year, or the income which is not received or which is received at the end of the, at the last day of the year. So where the income which is there, in respect of which you have exercised the option, the income where you have exercised the option. What is the income we are referring to? That the one which is received during the last day of the year or the one which is not received during the year. Are we getting that? So if your income is received on the last day of the year or it is not received during the year, then in that particular case, you have to exercise the option by filing the form 10 that it shall be deemed to be the income of the person in the year of receipt, and that will be considered as deemed application. However, if it is not applied for the charitable or religious purpose. If it is not applied for the charitable or religious purpose, right? Then in that particular case, it will be considered as the deemed income of the year. It will be considered as deemed income of the year in which of the previous year, immediately the following the year in which the income was received, or in the case 2 which was there, it will be considered as the deemed income of the previous year, immediately following the previous year in which the income was derived. Are we getting that? So, if I have not received the income, or I have received the income on the last day of the previous year, not received income or income received on last date of previous year. Now this will be if not applied. If not applied, or let me write like this. If not applied in year of receipt or in following year, deemed income of the following year of receipt, right? And which is received on the last day of the previous year, if not applied in following year, then it is deemed income of the following year in which derived. Fine, in which it is derived. Plus this will be taxed under 115 BBI. Fine. Okay. Then the next one is income which is deposited in modes other than section 11.5. So this we have already done. Where in the first case, which is there, income accumulated in excess of the 15%, where the accumulation is not allowed under the specific provision of the Act. There it also included this 15%, 1115. Sorry, that it also included 1115. But it will also include the case where the accumulation is not allowed itself under the specific provision of the Act, meaning I have not accumulated the entire income. I have accumulated some part of the income. Where I have accumulated some part of the income. In excess of the 15%, I have accumulated only certain part of the income. If I'm not going with the accumulation at all, then this clause will not apply. But if I'm going for accumulation, then in that particular case, and I'm not accumulating the entire income in the first scenario, then in that particular case, that will be considered as the specified income. Clear? Next one which is there, the last one, income which is applied for the benefit of the related person. So that also we have done that. Refer above, right? And the last one which is there, income which is applied to the charitable purpose outside India. So income which is applied to promote international welfare, in which India is interested, to the extent it is not applied towards charitable purposes outside India. So any income which is up to promote the international welfare, that income which will be there, that also will be considered as the specified income, which will be taxed at 15%. Is this clear till now? Any doubt? Yes or no? Any doubt? Yes or no? So income which is for the purposes outside India. Income which is applied to promote international welfare, or you can write for charitable purposes outside India. Okay, any doubt? Yes or no? Is this clear? It is shared screen, right? I don't know how it has paused. Yes, you can note down. After third, I have written over here in case it was freeze somehow. You can write down. Are you able to see the screen now? Yes. So what I have written after third, till third you have written income which is deposited in other modes, income for related person, and income which is applied for charitable purposes outside India. Please write down. I'll wait for you 2 minutes. Yes, have you written? No, Geeta, if it is for the purposes outside India, then it will not be allowed. The charitable purpose should be in India. The charitable purpose should be in India. Okay? Yes or no? Are you clear? Any questions? Any doubt? Shall we move on to the last part now? Yes? Tell me yes or no. Is it clear? Go through it. I'm giving you 1 minute time. Just read through the entire provision and then we will proceed ahead, because this is literally new thing. Yes? Have you gone through? Any question, any doubt? Is this clear? Yes or no? Past? Yes or no? 115 BBI, is it clear? So 115 BBI, I'll again very quickly revise. Income which is there, first accumulated or set apart in excess of 15%, where such accumulation is not allowed. Where such accumulation is not allowed, then in that particular case, this will be considered as deemed income. So income which is accumulated or set apart in excess of the 15%, where that accumulation is not allowed under the specific provision of the Act. So that is the one thing. Now, what is accumulation which is not allowed? Let's say, for example, as I said, that in a case where, let's say, I'm accumulating the income. I'm accumulating the income, but I'm accumulating only to the extent of certain income. Right? And in that particular case, if let's say, for example, I have not accumulated the entire income, or I have accumulated only a particular income, then in that particular case, that will be considered as specified income. Are we clear? Second thing we should note over here is that income which is accumulated, if it is withdrawn or if it is not applied for charitable or religious purposes, or for that matter, it is paid to any other trust, or at the end of the 5-year period, let's say, for example, it is not spent, it is lying unspent, then in that particular case, it will be considered as the deemed income under section 115 BBI. Third case is if it is not invested in the mode specified in the 11th, if it is paid to the related party, if the income which is received during the last year of the previous year or income not received, then if it is not applied for charitable or religious purposes, so that is the case. These are the scenario, and if it is for the charitable or religious purpose outside India or charitable purpose outside India. Crystal clear? Yes or no? Yes. Okay. Now we move towards the next important area. After 115 BBI, let's move to the next important area which is there, which is in the context of, again, going back to the very first thing. And the penalty now we will have to do. So going back to the advancement of the objective of the general utility. That is something we are going to look at. Again, that is provided in section 13 itself. Now, what does it say? Let's try and understand. Advancement of objective of general public utility. Okay, advancement of the objective of general public utility. Now, exemption to the trust will be denied if its main object as advancement of the object of general public utility trust if its trading receipts exceed the 20% of the total receipt. If the trading receipt, so what is the condition over here? Income should not be from trade, commerce, or business, right? Unless it is incidental to the main object and less than 20% of the total receipts. Right? Now, understand one thing over here. The charitable trust or institution who is having this objective may be a charitable trust in 1 year and not a charitable trust in another year, depending on the percentage of receipts from the commercial activities in each year. Therefore, it does not mean that the entire registration of the trust will become invalid. What will become invalid is that in that year, you will not be able to claim the exemption. So let's say, for example, if my receipts are greater than 20% of total receipts, then in that particular case, the registration will not be denied or cancelled. What will happen is exemption will not be available for that previous year. So let's say, for example, if previous year 21-22 is there and my gross receipts are, and my receipts from trade are greater than 20% of total receipts, then exemption not available. But let's say in 22-23, my receipts are less than 20% of total receipts. Then in that case, again, I can claim exemption under section 11. Are we getting that? So you have to ensure year on year what is the total receipts versus the receipts from this trade or operation. So in the year when you are exceeding, you will not get the exemption, but that will not mean that your registration will get cancelled. So section 13(8) ensures that the trust and institution does not get the benefit of exemption under 11 or 12 in the year in which the receipts from the commercial activities exceed the specified percentage, which is 20% of total receipts. But that does not mean that my registration altogether will get cancelled. My registration will not get cancelled. Are we clear? My registration will remain intact. Now, if the receipts from the trade commerce is in excess of the 20% of the total receipt, also in this particular case, or business greater than 20% of the total receipts, then in that case, that is one thing. Second, I have not maintained the books of accounts. Non-maintenance of the books of accounts. I have not audited the books. Plus, I have failed to file the return of income. Under section 139(1). Now, what are the consequences? Now, these consequences are given for the trust under section 1310 and 1311. 1310 and 1311. What will happen if these violations take place? Then in that particular case, the income minus specified expenditure will be allowed. Exemption will not be allowed. You are losing out on exemption. Exemption under section 10 or under section 11 not allowed. But what will happen is only the specified expenditure will get allowed. Now, what is the specified expenditure? What is the specified expenditure? So, sorry. Allowances and disallowances. Allowances and disallowances. The expenditure is not from the corpus. The expenditure should not be from the corpus of the trust, right? The expenditure should not be from corpus. From the corpus. Expenditure from loan or borrowings. Expenditure from loan or borrowing. So you will say, ma'am, that is any which was not allowed. Yes, that is any which was not allowed. Depreciation. Depreciation. Donations to any person. Donation to any person. So what is allowed is only the revenue expense. Only the revenue expense will be allowed, and any expense from corpus, from loan or borrowings, any depreciation, any donation to any person will not be allowed. Further, capital expenditure is also not allowed. Capital expenditure will also not allow. Second, disallowance you will make for (40AI) or 40A1 and 40A3 or cash expense greater than rupees 10,000 and disallowance under section 40A1 for non-deduction of TDS. Non-deduction or non-payment of TDS. Are we clear? So in case your receipts from trade, commerce or business exceed 20%, then only you will be allowed the revenue expense, and these expenses will not be allowed. So expense from corpus, any which ways it is not allowed even if you get exemption under 11. But you may say that if I'm getting exemption under 11, if I'm not getting the exemption under 11, I can pull out from corpus and claim that as expense. No, we will not allow that. It is not allowed for claiming exemption under 11. It will not be allowed to you also. Same is the case with loan or borrowings, depreciation, donation to any person, capital expenditure, and there will be disallowance under 40A1 or 40A3. You will ask, what about the repayment of the loan or borrowings? What about the repayment of the loan or borrowings? Will that be allowed? No, that will also not be allowed. Only the revenue expenditure. Repayment of the loan is the application of income under section 11. Loan repayment is not an expense. So that also will not be allowed. Are we clear up till this? Yes or no? Any doubt? Any question? Yes? Any doubt? Any questions till now? Is 115 BBI and this section 13 is clear? Yes or no? Yes or no? Fine. Okay. Now what is pending is, I want to see the answers from you. Yes or no? Is this clear? Money received from outside India, like foreign contribution for charitable purpose in India, that is considered as foreign contribution and it is governed by Foreign Contribution and Regulation Act, JECO. That will be considered. But again, the point here is that that is for the charitable purpose in India. So that you will consider for the purpose of application of income. Because that is for the charitable purpose in India. Yes, Geeta, it is lengthy, but it is how it is. And this is very important topic. You cannot leave it. Okay. Yes or no? Shall I proceed further? Because that's why, see, I'm devoting you this much time in this particular case because this is very, very, very important section. And wherever possible, I have given you a lot of examples also. Okay. So that even if the question comes, you will be able to solve it at least. By now, you will be in a position to solve this particular provision. Okay. Any doubt? Okay. Yes. So as far as the penalty under 271 AAE is concerned, it is only for the related party payment which is there. So if the violation is noticed for the first time during the year, then it is 100%. But in the next year also, let's say you have made the payment. In this year, if you have made the payment, it is 100%. In the next year also you have made the payment, then it will be 200%. Okay, where violation is noticed again. Fine. Okay, now we move towards the last part. Before we move on to the registration, okay, and we are also left with the private trust. So please pardon me for extending this lecture, but that is for your benefit. Okay. So now is exit tax or tax on accreted income. Exit tax or tax on accreted income. The last particular important part, but after this we will go very fast because then it is something which is not that difficult to understand, but this is something which is very, very important part which is there. Okay. Now tax on accreted income. Accreted income spelling I have put wrong. Now when this particular exit tax is applicable. So as I told you, this trust which is there is having the obligation. What obligation does it have? It has the obligation to, if it wants to claim the exemption, it has to do the charitable activity. So this particular exemption is coming with the condition. It is not that it is an unconditional exemption. It is not an unconditional exemption, right? It is coming with the particular condition. It is coming with a particular condition. So therefore, if it is coming with a particular condition, it has to get the particular charitable activity done. What are the charitable activities? That whatever the objective is there under 215 and what is advancement of general public utility, whatever, but it should do the charitable activity in accordance with its objective. Are we getting that particular point? Now, what is here important here is that if it is not doing the charitable activity, or let's say, for example, if it has been claiming the exemption for some years, if it has been claiming the exemption for certain years, then suddenly, let's say, for example, it winds up its activity and dissolve. It winds up its activity and dissolve, or it merges with another non-charitable institution, or it converts itself into a non-charitable organization. So the income which has been exempted over the period of years, that income is accumulated. That income is accumulated either under the assets, right? So when it is converting itself into a non-charitable organization or merging with another non-charitable organization, then we will levy the exit tax on the accreted income, on the income it has accumulated over the period of years. So exemption which is given under 11, 12 or 1023C is subject to the condition that the trust should perform the charitable activity. And where it is not performing the charitable activity, it should accumulate and invest the particular funds. Right? It should invest the particular funds. It should accumulate it. But where it is converting itself or merging with the particular another non-charitable institution, the corpus which it has built over the years, the accumulated income or the asset base which it has built over the year, for which it has claimed exemption, that has accreted over the period of time. It was given as the exemption when it was accumulating the income, it was investing in the mode specified in the 11.5. We were allowing it as application of income. We were exempting it with the promise by that trust that this would be used for charitable purpose in future. But when it converts itself into a non-charitable institution, it fails its promise it has made. It has revoked its promise. So then the government will also revoke its particular promise. Government said, we will give you the exemption. Even if you invest in the mode specified in the 11.5, you are accumulating it over the period for a specific purpose. And suddenly you are doing charitable activity, you claim 3 years exemption and done. I am non-charitable institution from now. So the government will also revoke it. So that is what the concept of exit tax is. This is under section 115 TD. Under section 115 TD. And what is this section? What does this provide? Where there is conversion of the trust. When it is applicable on the conversion of the trust. On the conversion of the trust into a non-charitable trust. Conversion of, either you can write here, charitable trust to a non-charitable trust. Second, merger with the entity not having similar objects. Merger with another trust not having similar objects. Merger with the trust not having the similar objects. Okay. So there also it will be applicable. And the last point here is C point. Non-distribution of assets on dissolution. Non-distribution of assets on the dissolution. So where it is either converting into a trust which is not a charitable trust, merger with the other trust not having similar objectives, it may be registered under section 12AB, but it does not have the similar objective, and non-distribution of the assets on the dissolution to any charitable institution registered under section 12AB or 1023C within 12 months from dissolution. If it distributes its assets to another trust after dissolution within 12 months, then this will not be applicable. Okay. So then in that particular case, this 115 TD will be applicable. 115 TD will be applicable. Okay. Further, if let's say, for example, this conversion of charitable trust into non-charitable trust, there will be deemed conversion into a non-charitable trust. Deemed conversion into non-charitable trust in two scenarios. where the registration has been cancelled. Registration has been cancelled. If your registration under 12AB or approval under 1023C has been cancelled, in that case, you'll be deemed to have converted from a charitable trust to a non-charitable trust. Second, it has undertaken the modification to the objects which do not conform to the conditions of the registration. Modification of the objects in contrast to the conditions for registration. So let's say, for example, if its object was relief to poor, but suddenly it started making hospital. It has obtained the approval for relief to poor, but now it is undertaking the hospital activity. Therefore, it will be considered that the charitable trust has converted itself into a non-charitable trust. Now, if that be the case, if this be the case, then in that particular case, in case of this, in this first case which is there, from the date of conversion, on the date of conversion, so this is my specified date. Here it is date of conversion, here it will be date of merger, and here it will be date of dissolution. Okay, here it will be date of conversion, or for this it will be date of cancellation of my registration. Here it will be date of modification. Right? In these scenarios, what will happen? I will have to pay the tax at the rate of what? What is the tax rate which is there? Tax rate is 34.944%. Maximum marginal rate. Tax at the rate of 34.944% on accreted income. On the accreted income. And what is my accreted income? My accreted income is what is the accreted income? The aggregate FMV of the assets, less liability. FMV of the assets. On which date? On specified date. And that's why I gave you the specified date. FMV of the assets minus the liability. Okay. Now, what this accreted income will not include? The assets here will exclude asset acquired out of agricultural income. So if I have acquired the assets out of agricultural income, because that was not in relation to the trust for which I was claiming the exemption under section 11. I was not claiming the exemption under section 11 for the charitable trust, right? So the exemption which I am claiming is for 1023C or for section 11. The section 10 exemption which is there for the agricultural income is completely unconditional. Isn't it? So therefore, in that situation, I will not consider the asset which is there generated out of that particular income. So if you know, let me tell you one point here. Where a trust or an institution is claiming the exemption under section 1023C or under section 11, then it cannot claim any other exemption under any section 10 except the agricultural income. So you cannot claim the exemption under other provisions also for securities, interest on securities or whatever, as well as 11 or 1023C. But for agricultural income, you can claim the exemption under 10.1 and you can claim separately the exemption under 1023C or 11. But for all the income which are exempt under section 10, you can either go for that or you come for section 11 or section 1023C. Are we getting that? So that income, the asset which is generated out of this income, out of the agricultural income, will not be considered. That is number one, very clear. Second, income which is in relation to any asset which is acquired when the charitable trust did not claim any exemption, when it was not a registered trust under 12AB or under 1023C, then that was not my exempt income which has been accreted. That asset was out of the taxable income. So even I will not consider that. Asset acquired by or asset acquired during the period prior to registration. Asset acquired prior to the registration, right? And the asset which has been transferred on dissolution to another charitable trust, because for that I will not be liable for exit tax. Okay, so asset transferred to another charitable trust within 12 months of dissolution. Okay, within 12 months of dissolution. So these assets are not to be considered in the asset minus liability. Are we clear? Yes or no? Fast. I'm understanding you must be tired, but please understand this is for your benefit, because if you miss out on this important class, let's spare some additional time, but let's finish off the last lecture properly. See, you've come up to this particular point. You have been listening since December. If you know, this last lab is always important. People who would have continued very properly till, let's say, 9 o'clock, but would have missed out on this. But this entire lab is important because then your dedication is proved. Okay, so please let's continue. Are you with me? Yes or no? Yes or no? Okay, so this is what the accreted income is. Accreted income is levied when the trust is converted into a non-charitable trust. No, it is deemed to be converted to a non-charitable one when its registration is cancelled under 12AB or 1023C, or it modifies its object which are not in accordance with the initial object with which it was formed. It merges with another entity which is different from its object, and if it does not distribute the assets within 12 months on dissolution to charitable institution. What is the accreted income tax? It is 34.944% on the accreted income. Accreted income means what? FMV of assets minus the liability. Are we clear? Yes or no? Yes. Now I'll show you very quickly. Let me share the screen of the module itself so that we finish it off faster. Now, what is the FMV of asset? What is the FMV of liability? That I will show you. Okay. So if you see here, first of all, when this particular tax has to be paid, where the registration has been cancelled, it has to be paid on the date on which the period for filing appeal expires, or the order in an appeal confirming the cancellation is received by the specified person. So the principal officer or the trustee of the trust will pay the tax on the accreted income within 14 days. So this has to be paid within 14 days from the relevant date. And what is the relevant date in case of cancellation of the trust? It is from the period for which the appeal against the order cancelling the trust expires, where you have not appealed for it. Where the trust has modified the objects 14 days from the end of the previous year. Where the trust has modified its object and has filed for the fresh registration, then again it's the same date, 14 days from the date on which the appeal period expires. Where the trust has merged with another entity, then it is 14 days from the date of merger. And where the trust fails to distribute the assets on dissolution, the date on which the period of 12 months expires. Okay. Then if you fail to pay the tax, it is interest at the rate of 1% per month from the date for which the tax was due till the date on which the tax is actually paid. Okay. Now, what is the fair market value? For the shares and securities, quoted shares and securities, it is the average of the lowest and highest price of such shares and securities quoted on the recognized stock exchange. Where no trading is done, then the average of the lowest and highest price on the immediately preceding date. For unquoted shares, it is A plus B minus L, which is book value of all the assets in the balance sheet other than bullion, jewelry, precious stone, as reduced by the income tax, as reduced by the deferred expenditure. B is the fair market value of the bullion, jewelry, and artistic work. And L is the book value of the liability, which is excluding the contingent liability amount which is set aside for dividend, reserves and surplus, and provision for tax. Right? And P is the paid up value of share capital. PV is the paid up value of the equity share for which we are computing the value. Okay. Then shares and security other than equity shares, the open market value which is there. Similarly, for the immovable property, it is either the stamp duty value or the open market value. For a business undertaking, it is the asset A plus B minus L, and it will be again determined in the same manner as what I told you. And any other asset, again, it is the open market value. Again, what will be the total liability? Total liability will exclude the capital fund, reserve surplus, contingent liability, provisions which are there, and any provision for tax which is there. Are we clear? Now, what we have to do is the registration part. So this is very simple. This valuation which is there is same as what we have done even under 5627B, right? So it's more or less same. Now I'll take you to the registration and the cancellation of registration. Give me a minute. Yes. We are here on the registration. So approval or registration for claiming the exemption. See, for claiming the exemption under 1023C or under section 11, you have to obtain the approval. For under 11, you have to obtain the approval under 12AB. Now, how is the approval required? Here we can see that. So institutions which were already registered prior to 1/4/2021, because this procedure came in 21, they have to make the application within 3 months from 1/4/2021. Okay. And this will be valid for a period of 5 years. And this will be granted from the earlier AY from which it was valid. In case it is a new trust. So if it is a new trust, or let me make a small diagram for you.
Recording stopped. Recording in progress.
Okay. Let me make a small diagram for you. This here, first you can write for the tax on accreted income, pay within 14 days from relevant date. Non-payment, you can write interest at the rate of 1% per month or part of month. Now, as far as the registration under section 12AB or 1023C is concerned, first you have to apply for the provisional registration. Provisional registration is first you have to apply. Or you can write here first. 1 second. Let me make it like this. New trust, which is there, will first apply for the provisional registration. Right. So the first registration which is given to you is the provisional registration which is given. So first is the provisional registration. It is given in case where it's a first time application. And when you have to apply, application by 1 month prior to the commencement of the previous year. 1 month prior to commencement of the previous year. Right? And in what time limit it is given? It is given within 1 month from the month in which the application is made. It is valid for how much period? Valid for 3 years. It is valid for 3 years from the AY immediately following the financial year in which the application is made. From year in which application is made. Now, once, let's say, for example, 3 years expire. Let's say, for example, the 3 years expire and your provisional registration gets over. Right? So, in that particular case, where a trust is provisionally registered, it can then apply after 3 years. Is expiring. So then you can take the final registration. Now, final registration, you have to take at least 6 months prior to the provisional expiry. Provisional registration expiry. And for what time period it is given? It is given for the 5 years. 5 years. And from when it is given? From the year in which it was provisionally registered. From AY in which it was provisionally registered. So it will be not given from the year in which you are applying for final registration. It will be given from the year in which it was provisionally registered. Okay. Then, in case your final registration is expiring and you want to renew, so it is a case of renewal, then again you have to make at least 6 months prior to expiry. And for how long the next will be given? Again, it will be given for 5 years. Now, this will be given for 5 years from the year in which application is made. In which application is made. Okay, so year in which the application is made. So this is what the registration is all about. Now, when you get the provisional registration, at that point in time, where the trust or institution is granted the registration under 12AB, the benefit of 11 and 12 will be available in respect of the income from which the property is held under the trust. But the object of the trust should be same. If you change the object, you will be levied exit tax and you will not be able to claim the exemption. You will not be able to claim the exemption. Are we clear? So if it is a new trust, then it has to be 1 month prior to the commencement of the previous year. And once provisional registration is over, then you can apply for the new registration, final registration. Are we clear? Now, when can the registration of trust be cancelled? The registration of the trust can be cancelled if the CIT has noticed the violations in the trust. If a reference is received from the AO, I'll show you in the module itself. See, the PCIT has noticed the occurrence of specified violation. It has received the reference from the AO to withdraw the approval. or there is a risk management strategy which has been formed. The PCIT can call for the documents and can then pass an order refusing or cancelling the registration. It can pass the order within 6 months. And what are the specified violations? Where the income from the trust which is not applied for the objects of the trust, where there are profit and gains from the business which are not incidental to, or separate books of accounts are not maintained for incidental business, where the trust has applied the income for the private religious purpose or for any particular community, or for the trust activities are not genuine, then in that particular case its registration can be cancelled by PCIT and you can make an appeal before the ITAT. Okay, you have to maintain the books of accounts, you have to get the documents audited in case your income before section 11 and 12 exceeds the maximum amount which is not chargeable to tax. Are we clear about this? And time period for which books is to be maintained is 10 years here. Time period is 10 years. Now the last part which I have to take with you. Please bear with me. I'm so sorry. Yes, Jacob. Yes, Anarga. Thank you so much. Kaushiki. Yes. Last part before we close the session and I say you all the best for your examination. Okay. So what is the last part is the private trust. So just write down again, this is very simple, but you can get a question around this. So you should be knowing the taxation. Private trust and the electoral and political party. Both of these we need to do it now. And it's very small part. It's not something which is big. So we will take it now for the consideration. So now in respect of the private trust which is there are two types of private trust. One is the specific trust and second one is the discretionary trust. What is a specific trust? Where the shares of the beneficiaries are specified in the trustee. Discretionary means where the shares of the beneficiaries are not determined. Now, if it is a specific trust, then where the trust income does not include business income, there is no business income. Then in that particular case, the taxability is under section 161. It will be beneficiary share separately taxable in the hands of beneficiary at slab rates as applicable to individual. Okay. Second, if there is a business income, if the trust has business income, then taxable at the maximum marginal rate. Then taxable is the maximum marginal rate. The exception to this is trust is declared by a will. Second, it is for the benefit of dependent relative. It is for the benefit of dependent relative. And it is the only trust of settler. The settler does not have any other trust. What is a settler? The one who puts his property into the trust. So a trust declared by a will, it is for the benefit of dependent relative and it is the only trust of settler. Otherwise, it will be taxable at the maximum marginal rate. If this is falling within the exception, then slab rates of individual. If it is a discretionary trust, where the shares of the beneficiaries are not known. So see, in the trust, how it operates is, let's say this is a private trust. First of all, remember, trust is not a person. It is registered either as a AOP or as a BOI. It is not a person. Trust is not a person under the definition of person. It is settled by settler. It is managed by trustees, and it is for the benefit of beneficiaries. So trust operates like that. Now, if it is a discretionary trust, again, where there is no business income, first there is no business income, then taxable at MMR. The specific trust is under section 161 and the discretionary trust is under 164. Taxable at MMR, again, there is an exception. Exception is where none of beneficiaries have income exceeding maximum amount or income exceeding basic exemption limit. Where the beneficiaries does not have income exceeding basic exemption limit and it is beneficiary of only one trust or this is and condition. Okay, this is the first condition, which is and. It is where none of the beneficiaries have income exceeding basic exemption limit and it is beneficiary of only one trust, or trust declared under will and is only trust declared. Trust declared under will or employee trust. Employee trust. And if there is a business income, if this is the case, if this falls within the exception, this will be taxed like AOP. If the beneficiaries have income, no income exceeding, if no beneficiary has income exceeding the basic exemption limit and they are the beneficiary only in this particular trust, then it will be taxed like AOP. Otherwise, if there is a business income, it will be taxed at maximum marginal rate. And if it has business income, this will be taxed at maximum marginal rate. This will be taxed at maximum marginal rate. Unless, again, the same exception here. What is the exception here? That the trust is declared by the will or it is for the benefit of the dependent relative or for that matter, it is the only trust of the settler. So then in that particular case, it will be considered as the slab rate. Okay, then in that case, it will be at the slab rate. Fine. I'm just pasting the exception here also. Yes. So if there is, it's a specific trust. If it has business income, taxable at MMR, unless it falls in exception. If it has no business income, then individual slab rate in the hands of the beneficiary. If it is a discretionary trust, then if it is no business income, it will be taxable at MMR. If there is a business income, again, it will be taxable at MMR only, unless it falls within the exception. If it falls in exception, if there is no business income, it will be taxed like AOP. But in case of specific trust, it is taxed in the hands of beneficiary. Or the trustee. Trustee in the representative capacity. Trustee is taxed in the hands as a representative assessee. Because trust is not a person, trustee is considered as a representative assessee of the trust. But since it's a specific trust, the shares of the beneficiary are known, it is taxed in the hands of beneficiary. In the case of the discretionary trust, where the shares of beneficiary are not known, it is taxed in hands of trustee in representative capacity. Also, one important point I would like to link over here, which we have already done so far, is that if the settlor is contributing to the trust, then in that particular case, it should not be a revocable transfer. If it is a revocable transfer, or if it is for the benefit of his wife or minor son, then in that case, the clubbing provisions will apply. We have done the clubbing provision, isn't it? We have done the, the daughter-in-law. If it is for the benefit of the daughter-in-law or the wife, then in that case, the clubbing provision were applicable. If it is a revocable transfer, or if it is for the benefit of his spouse, or if it is for the benefit of the spouse, or if it is for the daughter-in-law, son's wife, then in that case, the clubbing provisions will apply and the income will be clubbed in the hands of settlor. So you can just make a mention about here. If revocable transfer or transfer to trust for benefit of spouse, or transfer to trust for benefit of daughter-in-law. This is transfer by settlor, right? Then clubbing in hands of settlor. This is under section 60 and this is under section 64. Right? So clubbing of income in the hands of settlor. Fine. The last part is the political parties which is there. So last part which is there is the taxation of the political party. That I will do it from the module itself, and the electoral trust which is there. Give me a minute. I'll open it in the module. That's the very last part, I swear. Yes. Okay. Section 13A talks about the exemption from the tax to political party. So what is the exempt income? Income from house property, income from other sources, capital gains, and voluntary contribution received, provided the conditions are fulfilled. What are the conditions? It maintains the books of account. It maintains the record of the voluntary contribution in excess of rupees 20,000 and the address of the contributor. It audits the books of accounts. It does not accept any donation in cash excess of rupees 2,000, and it files its return of income. So that is what is for the political party. For electoral trust, again, it's the same. Any voluntary contribution received by electoral trust shall be treated as its income under section 224. For availing the exemption, it has to distribute the income to the political party. At least 95% of the donations received by it during the year, along with the surplus, if any, brought forward from the previous year. So that is about the electoral trust. Okay. And then there are certain other conditions that it shall not accept any contribution without PAN. It shall only accept the contribution through the account pay check, all of that. It shall maintain the records. It shall receive only political contributions from the individual who is resident of India, right? So that's what it is. So I'll just give you a small note for that. And then we are done. Political party exemption under section 13A. So what is the income which is exempt? Income from house property, income from other sources, capital gains, voluntary contribution which is there from the voluntary contributions received. Right? This shall be exempt. Conditions are maintain books of accounts, maintain record for contribution greater than rupees 20,000. No cash donation over rupees 2,000 or exceeding rupees 2,000. Okay. Filing ROI under section 139 4B within due date of 139(1). Audit of books of accounts by CA. Okay, so what will be taxable is the PGBP will always be taxable. PGBP of political party is taxable. Right, second point, again I'm linking it over here. Donation to political party. You get deduction under section 80GGB for company, donors, and 80GGC for non-corporate. Right? However, it should not be in cash. It should not be in cash. No cash donation. No cash donation. Okay. So you get the deduction under section 80GGB or 80GGC for the non-corporate. Okay. Yes. Is this clear now? I'm done with whatever I had to tell you. In case you have any questions, I'm there for 1 or 2 more minutes and then we can just close. Yes. Who is settler, Jacob? Settler is the one who gives the property in the trust, who distributes its property. If it is for the benefit of the beneficiary, the settler should not have any power over the assets to again get back the assets. Anarga, you can send your doubts. I'll give you a mail ID. I'll give you the email ID. You can just send your doubts there. It is this email ID. I'm writing it on my screen. You can write your doubts on this. No, I think it's getting copied in small. Let me write it. It is DT final @ici.in. You can send your queries here. Okay. Yes, Jacob, you have to go through the sums in the supplementary material. Anarga, we have done so many amendments in charitable trust. All these were amendments only. Thank you so much, Geeta. So I'm wishing you all the best for your examination. And I hope I have been able to, provide you what I had and what I could do best for your classes. So that is something I've already done. It's been such a pleasure to teach you since December. We are connected. Thank you so much, Prashant. Wishing you very, very all the best. Thank you, Jacob. Please do revise just last one thing before we close the session. Revise charitable trust properly. This is a highly amended area. I have given you so many charts. Just go through that and that will help you consolidating. And start consolidating now for your exam. You need to have everything handy for the last day revision. You will not get time. So please start revising now and start making your notes for the last day exam. Thank you so much, Kaushiki. Yes. So that's just one tip. And wherever you are making mistakes, make it a separate notebook and write down there. And please revise DT. DT is a very, very important area. And do practice the sums without looking at the questions. And solve as if you're solving for the exam. Not a rough practice. Okay? So thank you so much. and all the very best. Okay, good night.